Imagine you walk up to your bank on a Saturday morning, and the doors are locked. A little printed sign on the glass. Your app won't log in. The bank you kept your money in is gone. Not robbed, not hacked. It failed. So where's your money right now? If you saw the last video, you already know the uncomfortable part. It was never sitting in a vault with your name on it. The bank lent most of it out the day you deposited it. So when the bank dies, what actually happens to the money you can't see? Here's the good news up front. This is one of the few places in finance that's been quietly engineered so you almost never lose. Almost. There's a line, and if you're on the wrong side of it, you can lose everything. Let me show you exactly where that line is. First, what does it even mean for a bank to fail? It's not that the money physically vanishes. A bank fails when it can't give people their money back on demand. Because remember, the money is out working as loans. If enough of those loans go bad, or enough people show up for their cash at once, the bank runs out of the one thing it promised was always available, your deposit. At that exact moment, the bank is insolvent. It owes more than it can pay. In almost every country, it's now illegal for it to keep operating. And that's when a very specific, very practiced machine kicks in, one most people have never seen. Banks in America almost always fail on a Friday. On purpose. Because on Friday evening, after the branches close, a federal agency called the FDIC quietly walks in and takes over. Over the weekend, while you're asleep, they do something incredible. They box up the failed bank, comb through every account, and, most of the time, sell the whole thing to a healthy bank that's been waiting in the wings. New signs get printed, systems get switched over. And Monday morning, the doors open again. Same branch, same ATM, often the same staff, just a new name on the wall. For most customers, their card still works, their balance is still there, and they never miss a payment. The bank died on Friday and was reborn by Monday, and you barely felt it. That's not luck. That's the system doing exactly what it was built to do after it failed catastrophically once before. So why doesn't your money just disappear with the bank? One reason, and it's the most important number in this entire video, $250,000. Every deposit account at an FDIC-insured bank is guaranteed by the U.S. government up to $250,000 per depositor, per bank, per ownership category. If your bank fails and you're under that line, you get every cent back, usually by the next business day. Not eventually, not most of it, all of it. And this isn't a promise on paper that's never been tested. Since the FDIC was created in 1933, the number of insured depositors who have lost a single dollar is exactly 0. 90 years, thousands of bank failures, and not one insured depositor left holding an empty bag. Why 1933? Because before it existed, this went the other way. In the Great Depression, thousands of banks collapsed, and ordinary people's savings simply evaporated. Gone. No backstop, no refund. The $250,000 guarantee is the scar tissue from that disaster. It exists specifically so a bank failing never again means your savings failing. But I promised you a line, and here's the dangerous side of it. That guarantee has hard edges, and this is where people actually get hurt. 1. The money above $250,000. If you had $400,000 in a single account at one bank, the first $250,000 is safe. The other $150,000 is not guaranteed. You become what's called an uninsured depositor, and you only get back whatever the FDIC can recover from selling the bank's leftovers. Could be most of it, could be a fraction, could take years. 2. Things that aren't deposits. FDIC insurance covers checking, savings, CDs, money market deposit accounts. It does not cover stocks, bonds, mutual funds, crypto, or the contents of a safe deposit box, even if you bought them through the same bank. Those aren't your money in the bank. They're investments that can rise or fall, insured by no one. So the rule is simple, and it's worth burning in. The government guarantees your deposits, not your investments, and only up to the line. Let's make it real. March 2023, Silicon Valley Bank. In a single day, customers tried to pull $42 billion. By Friday, it was insolvent. The FDIC walked in that afternoon. Now here's the twist. Most of SVB's deposits were way over the 250 line. Startups with tens of millions sitting in one account. By the rulebook, they should have lost the excess. Instead, the government did something rare. It declared a systemic risk exception and covered every deposit, insured or not, to stop panic from spreading to other banks. Everyone got their money, but, and this matters, that was a political choice made in an emergency, not a guarantee you can count on. The only thing you can truly count on is the line, 250. And the biggest failure in U.S. history? Washington Mutual, 2008. $300 billion in assets, gone overnight. It was sold to J.P. Morgan Chase in a single weekend. Depositors? They woke up as Chase customers and lost nothing. The machine handled the largest bank collapse in the country's history over a Saturday and Sunday. So what do you actually do with this? Not panic. The opposite. If you keep more than $250,000 in cash, don't keep it all at one bank. Split it across banks or across ownership categories, and every dollar sits under its own guarantee. That's it. That's the whole trick the wealthy use, and it's free. Here's the honest bottom line. A bank failing sounds like the scariest thing that can happen to your money. The door's locked, the sign on the glass. But it's one of the rare corners of finance that was rebuilt after a catastrophe so that the everyday person walks away whole. Your balance was always just a promise. When the bank breaks that promise, a bigger one, the government's, quietly takes its place. Up to the line. So, 3 things to remember. A bank fails when it can't return deposits, not when the money disappears. Up to $250,000 per bank, you are made whole. Investments and the excess are on you. And the fix is simple. Stay under the line, spread it out, and a bank dying on a Friday is something you'll read about, not something that happens to you.